All right, good morning, everybody. So I think I know pretty much everybody in the room, but in case I don't, I'm Josh Lubas from MassMutual Strategic Distributors. So this morning, I'm also joined with Richard Neal, who's your key account manager managing the Plus Group relationship. So this morning, we want to cover three things for you. And these are some topics that you all asked us to talk about. First one is going to be mutuality. The second one is going to be future insurability. And the third one is around the importance of disability income in a financial plan. So let's kind of talk about mutuality first. I think the biggest value proposition for MassMutual is the fact that we are a mutual carrier. And, you have some mutual options on the shelf, of course, with Guardian and others. But from MassMutual's perspective, one of the things we absolutely love is planted everywhere. We are here to protect people's future and protect the ones they love. That's kind of who we are and what we do every single day. We secure people's future and protect the ones we love. Now, how do we do that? And why do we do that? And why is that different? So from a mutuality perspective, our number one concern is the policyholder. We are not thinking about or worried about shareholder prices, where our stock is at. We are concerned about a long-term vision about where the company is going and how we can protect those clients who already own our products because they are owners of our company. Now, one of the biggest values from a disability perspective, the other mutual carriers that you have access to do not have participating contracts. We do. So what is unique about that is that you actually have the option to share in the profitability of the organization. So what does that look like? In most states, the dividend becomes eligible after the 5th policy year. In some states, it's after the 6th policy year. I'm going to talk basically about our individual DI product first. Our illustrated dividend right now, and although it is not guaranteed, is being illustrated at 10%. Now, we have paid that very, very consistently over time. We also have had options in years where that dividend went much higher than 10%. On our business products, it is actually a 25% dividend, a significant return. But I talk about the dividend uniquely in that if you're purchasing from a mutual carrier, we're required by law to share in the profitability. So as you all know, companies price products based on an expected loss ratio. For the majority of carriers, we price it at a 50% loss ratio, meaning 50% of the premium we receive is going to then be paid out in claims. Now, let's say the company does great underwriting, solid, from a claims standpoint, and we actually perform above that expectation. We are required to return that back to the consumer. That is what is unique. So I always think of it as like a safety net that exists under the client. If the company does better, if we perform better, they get the return. That return hopefully will be at least 10%, but in many scenarios it goes significantly above that. So it is very unique, and from the portfolio that you all have access to, MassMutual is going to be the only option with a participating product. The second thing I want to talk about is taking a long-term view. So I think from a long-term view perspective, I'm not here to debate whether BIR is better or FIO is better. As you all know, Brian Orr just recently joined our team. He's doing an outstanding job. And this is one of the topics that he's been talking about a ton. He talks about options and control. So BIR is absolutely fantastic. But is BIR fantastic for every single consumer? Maybe not. FIO is fantastic. It does a great job. Is it perfect for every consumer that you're working with? Probably not. My question to all of you is, why are we putting a similar design together for every single client we work with? If we're going to spreadsheet options and we're going to go with the lowest price carrier, and if price is the concern, then why does every single design have COLA, have ONOC, have an unlimited mental nervous? We know we can save premium dollars by adjusting that a little bit. I think the same way about taking a long-term view. BIR is probably perfect for your resident marketplace. It fits really well, gives them an option to increase, there's a significant change in income. Maybe that increase every 3 years is absolutely okay. But perhaps you have a different client. Maybe they're emerging affluent or already affluent, and they don't have that long-term vision. Maybe they're getting significant growth on an annual basis, and they're concerned about how can I do this regularly? How can I control and manage my risk and protect my insurability while also having the ability to increase coverage over time? Well, FIO gives you that option. You could exercise an FIO for $100. You could exercise an FIO for the entire amount. You have options and you have control. So that's how I always connect back to that conversation, right? Options and control. And I'm taking that directly from Brian. Brian feels a little bit different. Brian loves to use FIO all the time. I personally think that there's a place for BIR, there's a place for FIO, and not one standard design works for everybody. We have to be flexible enough to decide. What is unique about the value proposition that we offer is that you have both of those options that are open and available to you. Now, the next is thinking about how do we take disability income, how do we take income protection and ingrate it in a financial plan? This is a huge buzz in the marketplace right now. We are seeing carriers evolve significantly. Days of going out and just being insurance salespeople, I sell life and disability, or I focus on annuities. Those days are changing very quickly. As companies think about profitability and they look at the interest rate environment that we're in today, assets under management are a huge focus. To be honest with you all, it's also pretty sexy, right? Selling DI, we all know, although this group thinks it's really sexy, a lot of the new advisors who are coming in don't necessarily see it as being as sexy. But I can tell you, and I know every single person in this room agrees, the basis of a strong financial plan has to be your ability to protect your income. It has to start there. Now, why? The biggest factor for me is that there is a significant difference between net worth and liquidity. You can see on the screen, a lot of these things are net worth. And if you took a look at it, if you were this consumer, we could probably call you affluent or emerging affluent, right? Your assets, your net worth is absolutely fantastic. But the question becomes, how much of this, if you became too sick or hurt to work tomorrow, how quickly do you have to access all of these dollars? And can you access them quickly? So what do you have to give up? Your $500,000 savings, your $500,000 beach home. Obviously, you got to maintain your primary residence. Your salary is gone. All of a sudden, you start checking these things off of your list. They're not super accessible. So do you want to liquidate? Do you want to have to sell that beach house? Do you want to have to eat up your savings? Absolutely not. Now take that savings and replace it with a brokerage account. So let's give you a real deal scenario. By the way, this is our Simplify tool. This is exactly what it looks like. You all have access to it. You can run this on your own. You can completely customize every aspect of it, and you can run this specifically for your clients. Think of this as an illustration supplement. So what I did is we designed this to just be very basic. This is a client making about $130,000. They have $250,000 in a brokerage account. So I'm going to take you through the chart. On the top, you see the brokerage account. On the left-hand column in blue, and the green side is going to be if they had disability insurance. So now let's think about it. If they maintain their life, everything is good. They had $250,000 in that brokerage account. They never added another dollar to it. Okay? That growth is going to get them by age 66 to $1.9 million. Pretty significant number, pretty decent retirement, right? I put $250,000 in, I get a $1.9 million return. That's what I'm going to use for retirement. Life is good. Now, that's in a perfect scenario. But let's just say that things changed. And let's say this client experienced a period of disability. They became too sick or hurt to work. It didn't last forever, though. It only lasted for 5 years. So we show that 5-year withdrawal out of the brokerage account. Now, keep in mind that their living expenses required them to have about $84,000 a year of net income to live their life, meet their expenses, keep a roof over their head and food on the table. Was about 84 grand. So they take the tax equivalent yield. Remember, as they withdraw from the brokerage account, they have to pay taxes on those dollars that are coming out. So now we assumed a 25% tax rate here. And I should have told you, we assumed a 6% growth. So that 1.9 million was at 6%. Of course, many people are doing it much better than that. So now they take directly out of that brokerage account for 5 years. Where does that leave them? At retirement, they went from 1.9 million to $234,000. You think that retirement's going to be impacted a little bit differently now? They were at 2 million, now they're at 234,000 because of a 5-year claim. Now, we all know that's the average claim, about the average claim in the United States, right? 5 years is not a long time. If that client went one more year, that brokerage account would completely be decimated. They would be left with $0. So what is the alternative? The alternative is what we all do every single day. The alternative is supplementing it and going out and buying a disability income policy. So to protect that $84,000 per year is going to cost them $2,480 annually. Now, we have to give that return. That total, paying that premium over their lifetime, is $255,000, okay? So we can add those two numbers together. They had $234 left in the brokerage account, $255 that they would save by not buying the disability policy. It puts them at about $500,000. Pretty bad versus that 1.9. Now, the alternative is they go out, they buy a policy from MassMutual. They also include COLA. Now that $84,000 continues to go up every single year. So we see the same exact systematic withdrawal, and you can see it in this column here, that $84,000 coming out. Guess what's happening to the brokerage account? Nothing. It's continuing to grow like normal. There's zero impact to the brokerage account. So what happens? They still got $1.9 million. Life is good. Retirement doesn't change because they planned ahead. They prepared for the worst case scenario. That claim could last till age 65. Guess what? They'd still have $1.9 million. They don't have to tap into it. That COLA is going to continue to increase, keep up with the cost of inflation. But remember, we did have a cost. The cost of that premium was $255,000, if you remember. So we net that down to $1.6 million. So here's the difference, folks. $1.6 million with DI, $500,000 without. So what this does is it literally breaks it down. By the way, this is the illustration. This is exactly as you will see it on the output. You can create it into a PowerPoint. This is consumer facing. It is compliance approved. So you can actually use this with clients. Your brokers can use this with clients. So we break it down and we net it out. There is a $1.2 million difference because they planned. And that is for a 5-year claim of a client who only had $250,000 in a brokerage account. Now imagine that this is an affluent client. Add a 0 to all of these numbers, right? So what was $1 million could be upwards of $10 million savings if that client instead had $2.5 million and perhaps was earning over $1 million a year, right? It changes that drastically. You literally, this model works. You can just add zeros to it, and you can see what the difference is. That 490, I love this visual because it's so blatant. It's so simple. It shows that significant difference of making DI the basis of your financial plan. Without doing so, you are risking your client's future. You really are, right? If they're not planning, if they're not part of it. So the story that we're going out and telling all day, every day, is you need to think about protection. Asset management is a beautiful thing. Growing someone from $250,000 to $1.9 million is outstanding. But what if? What if the worst case scenario happens? What if it changes? How are you protecting your client? Where are the dollars going to come from? These solutions and the solutions that you all offer can set them up for success. And this tool will allow you to tell the story in a really easy and effective manner. You don't have to think about it. You don't have to build it. It's compliant. You can put it on an illustration. You can brand it your way, however you want to do it. And this stuff can be run by you and your team. You don't even have to come to my team to do it. You all have full access to it. This isn't the only one, by the way. We know how partial disability is a significant concern in the marketplace. We need to think about, this is only showing a total disability scenario. What does a partial disability scenario look like? So we are launching our second module of Simplify that will be coming out in the next few weeks, which will break down partial disability. And it will look at this same type of scenario, but in the event of, I can only work part-time, right? Perhaps I have cancer or something like that. So I'll leave you with this, right? We all know the importance of DI. Our brokers are hesitant to push it. And I think a big part of the reason is, are we thinking about options? Are we thinking about control? Or are we putting the exact same design forward for every single client that comes in the door? So my challenge to all of you is think differently about it. Every client is different. Every client has different needs. Every client has different expectations. So think about how you can meet them. Perhaps it's a different carrier. Perhaps it's a different rider options. Perhaps it's showing a solution like this or many other great solutions that are on the street. This may not work for every single broker you work with. But the ones that are focused on asset management, it can be an unbelievable tool. So thank you all so much for the time. We truly appreciate the opportunity to be here with you.